Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good और मैं तो हमेशा मस्त ही रहता हूँ. Welcome to episode number 9 and mostly this is going to be the last episode of revision cum amendments in direct tax for May 23 and November 23 exams in 100% English language. For CA final primarily, but for the common topics, of course, the CA intermediate students are also following these lectures. In the last class, we have finished the chapters up to profits and gains of business or profession. So going ahead, next head of income, charging section 45, we are going to learn, we are going to revise capital gains. Whenever you have a capital asset and there is a taxable transfer, capital asset and taxable transfer, when both take place, then only we calculate. Otherwise, there is no calculation, there is neither a gain nor a loss. Capital gain will arise only if capital asset and taxable transfer. When both capital asset and taxable transfer have taken place, then capital gain or loss will arise and then only we will calculate. So when any of them have not taken place, so we will not calculate because it is neither a gain nor a loss. So then what are capital assets? Inclusion, we have to learn both capital asset and taxable transfer. Everything, whether movable, immovable, tangible, intangible, whether fixed or circulating. As a clarification, securities held by foreign institutional investors, FIIs, and the ULIP issued on or after 1st February 21. Go watch NRI taxation chapter definition of equity or mutual fund. ULIP, where the premium exceeds 2,50,000. So its maturity will be suffering 111A and 112A provision because we are putting it in the definition of equity or in mutual fund. So it is also a capital asset. In other words, everything is a capital asset except the following. Only the following will not be treated as capital asset. Everything else is going to be treated as capital asset. So what are the exclusions in the definition of capital asset? 1. Stock in trade, whether raw material, WIP or finished goods, because the sale of them is going to be obviously covered under business profession. Gold deposit bonds under that scheme of 1999 to remove illegal gold from the market. Special bearer bonds to remove illegal money from the market. Gold bonds issued at multiple occasions, 1977, 80 or 2015. Rural and agricultural. It has to be rural and agricultural. So, urban land, even if agriculture, it's a capital asset. And non-agricultural land, whether urban or rural, is a capital asset. Rural and agricultural land will be excluded from the definition of capital asset. Likewise, personal and movable. It has to be personal and movable, then it is excluded. So if it is a business asset, it will be a capital asset, or it is immovable asset, then it will always be a capital asset. It has to be personal and movable. However, following assets are personal and movable. Still they will be capital asset. Sculpture, artwork, drawing, archaeological collection, painting and jewelry. Sculpture, artwork, drawing, archaeological collection, painting and jewelry. They are personal, they are movable, they are personal and movable, but they are exceptions, therefore they will be treated as capital asset. That's capital asset. So anything that is not excluded here will be included in the definition of capital asset, and these assets will also be included in the definition of capital asset. But capital gain will arise only if there is a taxable transfer. So what is a taxable transfer? When you sell something, so transfer for money, exchange, barter, give one asset, receive another asset. That is also going to be treated as taxable transfer. Relinquishment or extinguishment. For example, an asset is destroyed, so your right over the asset is extinguished. But this is capital asset only if you have received some compensation. Only if you receive some compensation, it will be treated as capital asset, because if there is no compensation, then it will be a loss, because there is no selling price. Then it will be a loss. So excluded from definition of capital asset, so that the loss is not created. So if there is gain, it will be created, loss will not be created. And conversion of capital asset into stock in trade. We all know the entire story. Quickly I will tell you with the help of an example. Supposingly you purchase gold in 1 2 for rupees 1 lakh. At that time it was your capital asset. Then you convert it into stock in trade in the year 5 6. That means you take the gold from home to office, and on that date the fair market value was rupees 8 lakh. Finally the stock was sold in 20 to 23 for rupees 20 lakh. So when it was purchased, it was capital asset. At the time of conversion, the fair market value was 8 lakh. This is the period for which the asset was capital asset, and this is the period for which the asset was stock in trade. This conversion will be treated as taxable transfer. What we will do is, the FMV on this date we will take as selling price and minus the cost price out here. The holding period will only be this much, and the indexation will also be given only for this much period. Indexation will stop here. However, the taxability will arise here. We are going to stop the holding period and indexation here, but we are going to tax your capital gain year. 2001-2 is the acquisition year, so obviously no capital gain. 2005-6 conversion has taken place, therefore it is a taxable transfer. Capital gain has arisen, but it will not be taxable. Capital gain will be taxable in the year of sale of stock, but this year will be treated as the end of holding period and indexation. And finally, in the year 22-23, because we have done sale of stock, both business profession as well as capital gain will be taxable. This FMV will be taken as selling price in capital gain and cost price in business profession. So, selling price here minus FMV is business profit, and FMV minus purchase price here is capital gain. Holding period, indexation, everything will stop here. Only thing is that the taxability is going to be postponed to this future year. How are we going to compute the business income actual selling price in 22-23, and cost price will be the FMV as I discussed, that will be PGBP, and what is going to be your capital gain? The FMV on the date of conversion minus the original cost when you had purchased, it was a capital asset. Be careful, indexation will be from the purchase year till the date of conversion. Indexation and holding period will stop in the year of conversion, and if stock in trade is converted into capital asset, other way around, exactly opposite transaction, it is going to be exactly the same, and this time the FMV again will become cost on one side and the selling price on the other side, exactly the opposite transaction, same calculation. Here on the date of conversion, the holding period and indexation obviously will start because stock is becoming capital asset now. Okay, and last transaction here, compulsory acquisition. The calculation part is majorly similar. You purchase a house in the year 1-2 for 1 lakh. It was compulsorily acquired by the government in the year 5-6. Government promised you compensation of 18 lakh but paid in 2 installments, 8 lakh and 10 lakh respectively in 8-9 and 9-10. The compulsory acquisition is a taxable transfer. So, capital gain has arisen the moment this takes place. However, taxability will be postponed to the year of receipt of money, to the year of receipt of first installment. In this year, the entire 18 lakh will be taxable because deduction also we will take off the full cost of acquisition of 1 lakh. So, we are not taxing in the year of compulsory acquisition, we are postponing it to the year of installment. But once again, what is the importance of this year? End of holding period, end of indexation, end of holding period, end of indexation. So, 1-2 being the acquisition year, no capital gain. 5-6 is the year of taxable transfer. Therefore, there is capital gain but not taxable right now. Why? Because you don't have money. We will tax it when? In the year in which you receive your first installment. So, what is the importance of this year? End of holding period and end of indexation, end of holding period and end of indexation. Finally, in the year 8-9, when you receive your first installment, in selling price, we will take the full compensation of 18 lakh. Full compensation will be taken even if you have received one part, because cost also we are taking full, but indexation once again will be only till the year of compulsory acquisition, because after this you are not even holding. Holding period will stop, indexation will also stop. This will be your capital gain, and of course, when you receive the second installment, nothing will be taxable because you have already paid tax on the entire amount of 18 lakh. Here there is another possibility that the assessee is unhappy, dissatisfied with the amount of compensation that we have paid him. So, he may possibly go to High Court to get something extra over and above the 18 lakh. It is possible. If assessees agree with the amount of compensation, he may file a writ petition for enhanced compensation. In such cases, the capital gain will be taxable in the final order wala year. So, assessee is filing case in High Court. High Court will give the judgment. If none of the parties go to Supreme Court, then High Court judgment is final order, then in the year of High Court judgment. But if the losing party goes to the Supreme Court, then Supreme Court judgment is final order. That means we will tax the compensation in the year of final order. Money receipt is irrelevant here in the year of final order. So, let us assume assessee files a writ petition at High Court. High Court passes an order in the year 17-18 to give enhanced compensation. Total is 32, 18 was already given earlier. So, extra is, can I say, 14, and government pays this 14 in 18-19. Matlab, this is a case where government is not going to Supreme Court, which means that High Court order is final order. Then in the year 17-18, this 14 lakh will be taxable. The extra, because 18 you have already paid tax. But there is another possibility that the government goes to Supreme Court and Supreme Court decides total as 28 lakhs. So, not 32 but 28. So, first of all, on this 14 you don't have to pay tax if the government has gone to Supreme Court. Wait for the final order. Now, final order is coming in 22-23. On this final order, you have to pay tax on extra 10 lakh. How 10? Earlier it was 18. 32 is cancelled because we went to Supreme Court and Supreme Court decided 28. So, extra compensation of 10 lakh rupees will be taxed in the year of passing of order, and government has obviously paid you. So, in the year of final order, if High Court order is final, then 17-18 in our example, and if Supreme Court order is final, then 20-23 in our example. In the year of final order, the amount of enhanced compensation, here it was 32 minus 18, here it was 28 minus 18. Obviously, cost will be 0 because already you have taken the deduction, but the court case expenses, the litigation expenses ka deduction will be given, and this capital gain will be long term or short term, depends on original asset, because type of gain depends on type of asset. If this asset which was compulsorily acquired here, if this asset is latka, then this gain will be latsag, otherwise satsag. Understood? However, there are some transactions that are excluded from the definition of taxable transfer, means these transactions will not give rise to capital gain, like company distributing asset to the shareholder. For the company, the assets are only going, company is not getting anything, so it is not a taxable transfer. Likewise, HUF distributing anything on partition, any capital asset under a gift, will or inheritance or any kind of irrevocable trust, here the transferor is not getting anything, thus these transactions are excluded. It's a long list of about 3-4 pages, you can just go through the list. Most of them are not very important except the first few of them, so these transactions will be excluded. You will not be calculating any capital gain in the case of these transactions. Then once our asset is capital asset and our transfer is taxable transfer, we are going to compute the capital gain. What is going to be computation? First, we will take the gross sale consideration, full value of consideration, the amount which was received by virtue of transfer of capital asset, from which we will subtract our transfer expenses like brokerage or etc. We'll get our net sale consideration. From this we will get deduction of cost, or if long term then index cost. We will also get deduction of one more thing, that is cost of improvement, or if long term then index cost of improvement. This will give us our gross capital gains, and from which we get, they are called exemptions, but actually they are deductions, because only if you invest in another capital asset you are going to be eligible for that. So we are going to get exemptions from section 54 to section 54 GB, finally giving us our taxable amount. So one by one we will learn the various points in the computation and we get done. First point, gross sale consideration. What is GSC? Amount received in lieu of transfer of asset. When you give your asset, you receive something. What you receive is GSC. What you receive is GSC. What you receive is GSC, and AO does not have the power to question that amount. AO cannot tell you why have you received less, itna kam kyun mila. AO cannot ask you those questions. AO has no power to question the adequacy of GSC, except two cases where he can, that we will see, 50C and 50CA. He can question the adequacy. Otherwise, the AO does not have any power to question the adequacy of gross sale consideration. Now, what are special cases of GSC? Sometimes the amount of GSC is not going to be easily and readily available. You will have to put a little efforts. For example, in case of barter or exchange, you are not getting money, but what are you getting? You are not getting money, but what are you getting? You are getting some asset in return. That FMV of that asset which you have received, because what is selling price? Whatever we get in return. What is selling price? Whatever we get in return will be treated as selling price. If your asset is destroyed, then you will get compensation, and that compensation will become your sale consideration, and they are very clever. Taxable transfer only if the compensation is received. If you have not received any compensation, it will not be treated as taxable transfer. Next, conversion of capital asset into stock in trade. We already saw this. The FMV on the date of conversion will be taken as GSC and taxable in the year of sale of stock. Then transfer of capital asset, partner to firm and firm to partner, 45.3, 45.4, 9B. Go check partnership. We took that full explanation from our full course lecture so that you understand everything up to the rock bottom. Okay, so go and check the revision lecture of partnership chapter. Section 45.5, in case of compulsory acquisition, the compensation or the enhanced compensation will be treated as GSC. Compensation in the year of first installment, enhanced compensation in the year of final order. In case of joint development agreement, redevelopment, the stamp duty value of the property that you receive plus the money that you receive in return will be taxable in the year of receiving completion certificate. Then when you are shareholder in a company and the company goes under liquidation, the company will give you assets. For the company, it is not a taxable transfer, but for you, the shareholder, it is asset received against shares. Asset received against share. So FMV of the asset minus the free reserve, because this much amount will be taxable in IFOS, dividend. Whatever is the fair market value of asset received, the amount to the extent of free reserves, including bonus, because that is also given from the reserve, that much amount will be treated as deemed dividend. So that will be treated under IFOS, and the remaining FMV will be taken as selling price under capital gain. Next, whenever you do transfer of immovable property, 50C, so here you can question transfer of immovable property. So actual sale consideration or stamp duty value, whichever is higher. Actual sale consideration or stamp duty value, whichever is higher. But on the request of the assessee, the AO can appoint someone called a valuation officer, to find out something in between. If the valuation officer's value is less than assessee value, then actual consideration will be GSC. More than stamp duty value, then stamp duty value only will be GSC, because the VO has to stay between the two values, and if the VO's value is between the two value, then VO's value will be taken as the gross sale consideration. Further, here 50C, also 43CA for PGBP, and also IFOS में for the receiver of immovable property for inadequate consideration. All the three places we have what option to take agreement date stamp duty value instead of possession. So don't take the stamp duty value when you give possession. If you have done an agreement on an earlier date, then take stamp duty value on that date. Agreement date stamp duty value instead of possession date, subject to conditions. Condition 1, there has to be some amount that was received at the time of agreement. Otherwise, how will you prove that you have done agreement at an earlier date? There has to be some amount received. It can be any amount, and that has to be in the allowable modes. Otherwise, people will say, I paid 1 rupee in cash. There has to be some advance received at agreement in allowable modes. Then you can take agreement date stamp duty value instead of possession date stamp duty value. Further, if the difference is up to 10% of actual, so this 10% will not apply on HDD. You have to check on actual. Be very careful on actual. Plenty of MCQs we have on this. Up to 10% of actual, then actual will be accepted without going into any fight. We are giving you this privilege. Up to 10% of actual. If the difference is up to 10% of actual, then no problem. For example, if the actual sale consideration is 50 crore, stamp duty value is 54, difference is 4, it is within 10% of actual, then take 50 crore as GSC. No need for VO or agreement date or anything. 50 crore and 56, this is more than 10%, then 56 will be taken because the difference is more than 10%. 50, 55, this is equal to is also allowed, then 50 will be taken. And whenever immovable property is held as stock in trade, all the points will be same for the income under PGBP. That section is 43CA, absolutely same as 50C. 50C is for capital gains and 43CA is for business or profession. Next, 50CA, sale of unlisted shares. Whenever there is sale of unlisted shares, here also the AO can question the amount. He will take actual amount or FMV, whichever is higher. Actual or FMV, whichever is higher. Actual or FMV, whichever is higher. And of course, if the amount of gross sale consideration cannot be determined, then it will be FMV of the asset transferred. If you remember the Deepika ji example in class, if the amount of GSC cannot be determined, then it will be FMV of the asset transfer. Normally, we take FMV of the asset received. But if we cannot compute that, then we will have to take FMV of the asset transferred. That is how we will identify our gross sale consideration for the purpose of computation of capital gains. Let's go ahead. Next step in the computation of capital gain, transfer expense. Any expense wholly and exclusively incurred for transfer like brokerage, commission, registration fees, advertisement, they will be allowed. Vague expenses which are unrelated obviously will not be allowed. After transfer expense, we directly get net sale consideration by using our calculator, so nothing that we have to do out there. Now we go to cost of acquisition. What is cost? The amount incurred to acquire any asset, including all expenses before using the asset for the first time. Something that you have been doing in accounts all your life, that is going to be cost of acquisition, and obviously it will be eligible for indexation, where ICOA is COA into CII of transfer year divided by CII of acquisition year by the assessee. And this discussion also we have had in NRI taxation chapter. You can have a look at it to understand what I am saying. Okay, like, share, subscribe, hit the bell button. Like ठोक दीजिए. Special cases of cost of acquisition like we had in GSC. So section 49(1), one of the most important cost to the previous owner. When X purchased a property in 1,2 for 5 lakh but died in 5/6, so obviously the property will go to the legal heir. However, this is not a taxable transfer for obvious reasons, because X is not getting anything. So there is no capital gain for X, but there is FMV on this date. Now, Y when later sells this property in 2022-23 for 20 lakh rupees, obviously Y will have capital gain. Selling price will be 20 lakh, but what will be taken as cost price? Can we take this FMV? No, because then we are taxing only this much. We have to tax the full amount, and therefore from the selling price of the current owner, we will subtract cost to the previous owner by imagining that both of them are the same person. So cost for Y will be the cost of the previous owner. X selling price will be sale consideration minus cost or index cost of X. The holding period will be taken from 1/2 to 22-23. That means cost we will take from here, holding period from here, cost, holding period, cost, holding period. But the most controversial aspect, if you read the plain language of income tax law says that indexation will be from the year when assessee got it, and assessee is Y. And therefore indexation according to the act will be from 5/6, means from this period to this period, means cost from here, holding period from here, but indexation from here, cost, holding period, indexation. But Bombay High Court said that this is not fair when you're taking everything here. Then in the case of Manjula Jesha, Bombay High Court said that indexation will also be given from 1 to 22, 23. So cost holding period indexation. Everything in the exam you can do. I think Bombay High Court judgment is more logical, but based on whichever cost inflation index they have given. And if they have given both, you do anything and write a note. Please make sure that you write a note that I am following Bombay High Court judgment or not following. In fact, this is one of those case laws, rare case laws which we teach CA intermediate students also. And if the previous owner also acquired through not a taxable transfer, then we'll obviously go to the previous owner before that person. So ultimate previous owner who acquired through a taxable transfer. That is how we will do in not a taxable transfer inheritance cases. Depreciable assets, WDV, opening plus purchases. That is the value in the block. Self-generated asset like goodwill, cost is going to be nil. You have the option to take FMV on 1401. If an asset was acquired before 1401, then there was no cost inflation index because base year is 0102. Then for such asset, you can take actual cost or FMV on 1401, whichever is higher. So that FMV will incorporate the indexation, and then from 1401, you can index it. Actual cost or fair market value on 1401, whichever is higher. And when we take this actual cost, it is also going to include if it was actually acquired by the previous owner. So the cost of the asset will be included if the cost of the asset will include if the asset was acquired by the previous owner. This section will apply to all assets which are acquired before 1401. All assets which are acquired before 1401, including bonus shares. Even on bonus share it is going to be applicable, but not on depreciable because depreciable asset always short term, and second, self-generated because anyways the cost is 0. So bonus also acquired before 1401, you can take FMV as the cost, but not for depreciable assets and self-generated asset. And if the FMV, if the asset is immovable property, so as a clarification, whatever be the FMV, you can, cheat with the valuers hand in glove. You can join hands with them for cheating purposes. So we will restrict the FMV to HDV. So actual or FMV, whichever is higher, but that FMV cannot be more than the stamp duty value on 1401. The FMV cannot be more than stamp duty value on 1401. Cost of bonus shares 0, but as we already discussed, FMV option is going to be given. Cost of right shares to the existing shareholder, they have to buy, like Adani offered people further issue. So whatever you pay to the company is going to be the cost of right share. But what about cost of right share to the outsider? Because outsider has to first purchase the right from the existing shareholder. So paid to the existing shareholder for the right plus paid to the company for the share. That total will be treated as cost of right shares for the outsider. And what about the right entitlement? Do we know that the existing shareholder has sold the right? He's not sold the share, the right. And that will be 0 because the right ke liye he has not paid anything. The right has come free with the original share. So cost of that right is going to be 0. Cost of sweat equity shares, FMV on date of allotment, because on this FMV you've already paid tax under perquisite. Cost of asset received as gift, again FMV on receipt because this FMV is already taxed under income from other sources. Shares in an amalgamated company, whatever you paid in the old company will become cost in the new company. Your expense in the old company will become cost in the new company. And what about demerged and resulting company? Whatever was the original cost of acquisition in one company, that company will be split. Portion of assets will be transferred in course of demerger. So whatever has been transferred, that will become your cost in the resulting company, and whatever has been retained, that will be your cost in the demerged company. You spend 1 lakh rupees and become a shareholder of a company. That company splits, transfers 40% of its net worth to another company. So your cost will be 60% in the existing company, that is 60,000, and 40,000 in the new company. We will split in the proportion of transfer. In case of slump sale means when we are selling our entire business as a whole in lump sum, then it is called slump sale. A transaction will be treated as a slump sale if 1. All assets and liabilities have to be taken over. Second, no value should be assigned to any individual asset or liability. All assets and liabilities, and there has to be one selling price, total selling price, to decide that it is a slump sale. In that, first of all, when we take selling price, there is one amount which we are receiving. One amount that we are receiving because we don't have breakup of individual assets. In that also, auntie has made some changes. I have mentioned first, let me talk about the selling price. GSC will be A or B, whichever is higher. A will be the actual amount that you receive. Plus sometimes you can receive assets also, no? So uska fair market value, and if it is immovable property, then stamp duty value. Supposingly I am selling my business, entire business to you. You are paying me 1 crore rupees in cash and then you are giving me some assets as consideration. The total consideration is monetary and non-monetary. That is also slump sale because I am selling my entire business. All assets and liabilities, and we in the sale deed are mentioning only one amount. Correct or no? So, what will be selling price? Amount received plus FMV of asset received, but if the asset is immovable property, so we will take stamp duty value. However, there are some assessees who are under declaring this amount, like they were declaring, like they were doing in 50C and CA. So, what we will take? We will also take the net worth of the undertaking that is being transferred. Net worth means assets minus liabilities. In assets, immovable property ka stamp duty value, bullion, sculpture, artwork, etc. ka fair market value. Other assets like debtors, cash, bank, stock, unka book value. Immovable property ka stamp duty value, bullion, sculpture, artwork, drawing, etc. we will take FMV, and current assets like stock, debtors, cash, we will take book value. That is the assets ka worth of the undertaking being transferred. And we will take the book value of the liability. So, this is the net worth. You can say like the fair market value. So, the actual amount received or the fair market value out of the two, whichever is higher, will be taken as GSC. Once upon a time, there was only money received, that was GSC. But now they are saying that instead of money, you can receive other assets also. So, we will take that value. Plus, we will also check the net worth of the undertaking being transferred. That is assets. This is how you will take the valuation. And minus liabilities book value. A or B, whichever is higher, will become GSC. Transfer expense you will take, you get NSC. There will be no indexation in slump sale because the entire unit is being transferred. And what will we do with the cost? Cost of acquisition is going to be net worth of the unit being transferred. Net worth. So again, assets minus liability. In assets, how to take valuation? Here we will take WDV of depreciable assets. So here they are very clever. They are taking book value, but here they are taking WDV. For non-depreciable asset, you can have something that like a land. So they are taking book value. Here if there is land in selling price, they want to take stamp duty value. But here they will take book value. In the costs, in selling price they want to take higher. In cost they want to take book value. Very clever. Sahi khel gayi. Aunty sahi khel gayi. And other assets where you've taken cost as full deduction in scientific research or specified business. So 0. That will be total of assets minus your liabilities. That will be the net worth for the purpose of cost. So net worth for the purpose of selling price mein we are taking higher values. Immovable ka stamp duty value, fair market value. Lekin for the purpose of cost of acquisition, we are taking book value. Understood the smartness? Auntie has done this. Okay. That will give you your capital gain under slump sale. If there is any advance money which is forfeited in a failed property negotiation. So, in the olden days, up to the previous year 13-14, assessment year 14-15. PY 13-14, AY 14-15, we used to subtract that from cost of acquisition in future sale. But from PY 14-15, it will immediately be treated as IFOS and therefore not deducted from cost. It was a prospective amendment. So remember to check in which year forfeiture has taken place. If the forfeiture took place up to 13-14, then minus from cost. But only if it is done by current owner, because any forfeiture by previous owner was going untaxed. And if the forfeiture was done by the current owner from 14-15 onwards, then it is already taxed under IFOS. You don't need to subtract it from COA again. And if cost of acquisition cannot be determined, then you have to take the FMV on the date when you acquired, not when you transfer. If it is not possible to determine, then FMV on the date of acquisition. Next, we have cost of improvement. One more deduction that we get from our net sale consideration. All expenses incurred to get enhanced value of GSC. To increase the value of your gross sale consideration, if you have incurred any expense, then that will be called cost of improvement. This can be incurred by the current owner or the previous owner, and it will also be eligible for indexation, where it is cost of improvement into CII of transfer year divided by CII of improvement year. Improvement year, irrespective of who did it, and therefore there is no impact of Manjula Shah, because improvement year, anybody who has done it, we will take it from that year. Obviously, depreciable assets and self-generated assets, it is not going to be available. And if you have incurred any improvement cost before 1401, it will be ignored. Sir, why? Sir, it is already taken in. Sir, it is already taken in the FMV option. Whether you exercise that option or no, that is not our problem. We will not give you deduction of any COI which was incurred before 1401. Last part of capital gain, certain exemptions from capital gain. First, section 10 exemption, which are actually exempts. Amount column directly 0. 1037. For individual HUF, if there is compulsory acquisition, it's a taxable transfer. And urban agricultural land is a capital asset. Rural is excluded from capital asset. Urban is a capital asset. So there is capital gain, but it will be exempt. Whether long term or short term, it will be exempt. So compulsory acquisition of urban agricultural land is going to be exempt. And 1037A, at the time of redrawing of Andhra Pradesh and Telangana borders, at the time of that scheme, whoever was owner of land in the border areas, they have surrendered that land. So long term and short term both capital gains will be exempt. Now we have exemption under 54 series. Here it is called exemption, actually it is deduction, because you have to invest in another asset. Only if you invest in another asset you will get this deduction. If you don't invest, then your capital gain will be taxable. These exemptions of section 10 always exempt whether you invest or you don't, but here only if you invest. Most popular section 54, you've done sale of residential property. Who will get the exemption? Only individual HUF, only if the capital gain is long term capital gain. How to get it? Acquire another house in India. You can acquire wherever you want, but you will get exemption only in India, and this exemption will be for maximum one house property in India. You can acquire 10, but exemption of 1, and that also in India. But when the houses are next to each other, units adjacent to each other, then they will be considered as one house property, and accordingly you can take for multiple. If they are next to each other, you can take for multiple also. Plus, if your capital gain is up to rupees 2 crore, not the selling price, the gain amount, then once in a lifetime you can take exemption of 2 houses also. Means if they are next to each other, they are one only. But supposingly one house you purchase in Pune, other in Chennai, they cannot be next to each other. If your gain is up to 2 crore, you can take exemption of both houses, but that you can do only once in a lifetime. You have to purchase the new house 1 year before or 2 years after the transfer, or construct within 3 years after the transfer. So if this is the transfer date, purchase 1 year before or 2 years after, or construct within 3 years after the date of transfer. And what will be your exemption? The amount that you have invested in the new asset, or your amount of capital gain, whichever is lower. Capital gain or investment, whichever is lower. So if your gain amount is invested, it will be fully exempt. However, the new asset that you have acquired cannot be sold for a period of 3 years, cannot be sold, and if sold, then what will happen? The new asset ka capital gain will come, and in the cost of that new asset, we will subtract the exemption that you have taken. So selling price of the new asset minus cost of that new asset, which was your investment. But in this cost, whatever exemption that you have taken, we will subtract. So the exemption taken earlier will now become taxable by reducing it from the cost of the new asset. Therefore, we will increase the gain of the new asset. The gain of the new asset will include the gain of the old asset and the gain of the new asset. The exemption that you took on the old asset and the gain that you have earned on the new asset. And if you don't want to purchase the new asset, then up to the due date of return filing, you can simply invest money in the capital gain deposit account scheme. And here your exemption will be the capital gain or the amount invested. However, within the time given in the section, for example, here you had 2 years or 3 years. Within the time given in the section, use it for acquiring the asset. You can't just keep it in the deposit account. You will have to use it for the acquisition of the respective asset. Otherwise, the unutilized amount will be taxable in the year of expiry of that whichever time limit. Here we will wait for 3 years, but in other sections there is only one time limit given. So at the expiry of that time limit, we will tax the unutilized balance in the capital gain deposit account scheme. Similar lines pe we have our other exemptions. If there is sale of urban agricultural land, first of all it has to be urban because rural is not a capital asset. Second, it has to be sale because compulsory acquisition is exempt. Then this capital gain will be taxable, but you can invest and save. You who individual HUF. This can be for long term, short term, both, but the land should be used by assessee or parents for minimum 2 years for agricultural purposes. How will you get your exemption? Purchase another agricultural land. There is a defect here. They have written agricultural land. It can be urban or rural. So sell urban, buy rural, and you still get your benefit within 2 years from the date of transfer. So now we have only one time limit. The rest is same. So investment or capital gain, whichever is lower. Lock-in period is same. Contravention, if you do, it is same. But of course, if the new asset is rural, so the new asset ka gain only is not going to be calculated. So if there is contravention of lock-in period, you still escape, and CGDAS deposit account scheme will be same. Compulsory acquisition of land and building if government has done. So all assessees can use that money to acquire another industrial land and building, whether it is long-term gain or short-term gain. But the industry should have been run for minimum 2 years. Purchase another industrial land and building, and within 3 years from receipt, because this is compulsory acquisition, everything, the quantum, the lock-in period, contravention of lock-in period, and CGDAS, everything is same as 54. 54G and GA, whenever you are selling plant, machinery, land, building for shifting an industrial undertaking from urban area. So in an urban area, you are selling these assets in your industry, and moving where? If you move to rural area, then you have to sell these assets. this is your exemption, and if you move to SEZ, then this is your exemption. Except this difference, everything else is same. So the place of moving, if rural, then 54G, and if SEZ, then 54G(a). This is also for all assessees, whether long term or short term. In the new place, rural or SEZ, acquire land, building, plant or machinery. Purchase 1 year before or 3 years after. Here we get total of 4 years ka time limit, and the rest of it, quantum of exemption, lock-in period, contravention of lock-in period, and capital gain deposit account scheme, once again same. Next we come to 54EC. 54EC. This is also available for all assessees. Sell any immovable property and invest in bond. Abey James Bond nahi, NHI, RECL or notified bond. Sell immovable property which is long term. So capital gain on this immovable property is long term, and with this money acquire NHI, RECL bonds or any notified bonds like Indian Railway Finance Corporation, Power Finance Corporation. Sell any long term asset which is immovable property and acquire these bonds within 6 months. Here we are giving you only 6 months because this is not property. Okay. So sell any immovable property long term and acquire bonds. Quantum same. Amount invested or capital gain, whichever is lower, but your exemption will not be more than 50 lakh. So if you have gain of 2 crore, investment of 1.5 crore, exemption will be maximum 50 lakh. What is going to be your lock-in period? Same, but here you cannot just, not selling is also not allowed, and you cannot do any pledge mortgage of these bonds. Also, just a clarification, on or after 1/4/18, I don't want any confusion. The lock-in period will change from 3 years to 5 years. For everything else it is 3 years, but for this section it will be 5 years. The lock-in period will be 5 years. Contravention of lock-in period will be same, and deposit account scheme will not be available because for 6 months time limit there is no deposit account scheme. 54F. Sale of any asset except house property. When you sell house and you buy house, then 54. But sell anything else, sell shares, sell jewelry, sell gold and acquire house property. Who? Individual HUF, and the gain on shares, land, gold, jewelry is long term. Acquire a residential house property, same, maximum 1 in India. Purchase 1 year before, 2 years after, construct within 3 years after. The difference in 54F is here you have to invest the sale amount. Everywhere else you have to invest the gain amount, but here you have to invest the sale amount. If entire net sale consideration is invested, so supposingly GSC, transfer expense, this is NSC. Assume this is your cost, so this is your capital gain. If you invest 50 lakh, then 35 is exempt, nothing is taxable. But you invest 25, so only 50% of your NSC is invested, then only half will be exempt, the other half will be taxable. Like NRI taxation, you have to invest the NSC amount here, not the gain amount. Other points are same, and for unutilized balance being taxable in CGDS, obviously this time it will not be fully taxable because exemption is also proportionate, so taxability will also be proportionate. Last, there are a couple of questions on this, so you should just read through it. That way it is not so important that we have to discuss. You have sold a residential property, okay, it can be land, house, okay. You are individual HUF and the capital gain is long term. What to do with that money? Invest in equity shares of eligible company or startup. So you've sold a property, you individual HUF, sold a property, long term capital gain. With that money, acquire equity shares. Within what time? On or before the due date of return filing. For property, the time limit was up to 31st March 17, means for investment in share, but for startup it is 31st March 22. Surprisingly, this date has not been extended even after COVID. So that way, if you see, the time limit of investment is gone, and यहाँ पे भी investment का calculation is same. You have to invest your net sale consideration. Otherwise, the amount invested plus deposit in CGDS upon net sale consideration into your capital gain will be exempt. And if the unutilized amount is that, then the proportionate exemption will be given. For lock-in period, shares is 5 years, and for computer software it is going to be 3 years. If not utilized, then it is going to be taxable. That is how 54GB works, but because 31st March 22 is not extended, that way it is irrelevant, so we don't discuss it in our full course lectures also. That was our chapter capital gain ka revision. Moving on to the last head of income from other sources, charging section 56. If there is income which is taxable and not covered anywhere else, there is income, because this is income tax, and taxable means it's not covered in exempt income and not covered in salary, house property, PGBP or capital gain, then it is going to be IFOS. Like these incomes, they are going to be treated as income from other sources. However, some incomes will be specifically covered under income from other sources. For example, securities held as investment, uspe if you get interest, then it will be income from other sources. Letting out of plant and machinery and furniture, if it is not your regular activity, then it is going to be income from other sources. Dividend will always be income from other sources. Even if you are share dealer, share ka profit can be PGBP, but dividend will be always IFOS. Gift excluding employer, obviously, because employer ka gift will go in salary. All other gifts will come in IFOS. If you have any casual winnings, it will compulsorily be IFOS. Casual winnings will always come under IFOS, even if you make it your main activity. Other things we already know. Flat 30%, 115BB, no deduction of expense, no basic exemption, no chapter 6A. If you have any activity of owning and maintaining race horses, if you are running a stud farm, then that is going to be IFOS, but only horses are used. Your horse word is used here. So if there are other animals, race camels or race dog or anything, then it will be PGBP, and here all the normal provisions will be available. So normal tax rates, deduction will be allowed, basic exemption, everything is going to be allowed. Only common thing is both of them are IFOS. If you have any family pension paid to the employee's spouse after the death, then that will be IFOS, because the spouse does not have employer-employee relationship. However, here we get deduction, 1/3 of the amount received or 15,000 per annum, whichever is lower. 1/3 or 15,000 per annum, whichever is lower. However, family pension of those who died during duty, member of armed forces including paramilitary, and if you were receiver of bravery award, even if you have not died, it is any of them. If you die, then whether you receive award or no, it will be exempt. And if you receive award, whether you die or no, it will be exempt. Interest on compensation, enhanced compensation. Compensation capital gains, enhanced compensation capital gain. But interest will be taxable in IFOS in the year of receipt, flat 50% deduction. IFOS year of receipt, flat 50% deduction is going to be given. Any MP, MLA sitting fees will be taxable under IFOS for attendance what they get. However, daily allowance and constituency allowance is going to be exempt. When a director is attending board meetings, he also gets sitting fees, that will be IFOS. But managerial remuneration will go under salary. Only sitting fees is going to come here. Any advance money forfeited in 14-15 or later. Advance money forfeited in 14-15 or later. Up to 13-14 it was subtracted from cost, but 14-15 or later, then it will be treated as income from other sources. Composite rent, when it is house and other assets, we've already discussed in house property. If you can separate them, then house ka it will go in house, but other assets ka business, or if irregular activity, then IFOS. But when it is not separable, it is one amount, then it can't go in house property. It will be PGBP or it will be IFOS. Then when you are letting out a open land, plot of land, vacant land, if regular activity, then business, otherwise income from other sources. Any compensation on termination of employment, because if your employer is giving, it will be salary, but it can be a professional assignment which got terminated and you got compensation. A professor doing contract with a coaching class of a certain number of years. I completed my contract with all the outstation organizations that I was working, whether Ahmedabad or Kerala, wherever I committed a period, I completed my assignment and then left the job. But if I would have left in between, then so normally if I pay compensation to the organization, it is PGBP, or organization pays me compensation if I am working as an employee, so it will go under salary. But supposingly we tell each other that we are discontinuing the profession altogether. Okay, supposingly I leave, so the profession only is discontinued. Then people are claiming, sir, it will not come in business because I have stopped my business or profession. No, if it will not come under business, it will come in IFOS, but it will be taxable. Likewise, royalty income will always come under IFOS because you are not actively involved. Agriculture income outside India for resident. In India is exempt, outside India will be taxable. Against our IFOS, we will be getting some deduction. Against dividend and mutual fund, only interest, like other bank collection charges or manager or office expenses not allowed. Only interest, that also maximum 20%. So if your dividend is 5 lakh, you have 80,000 interest expense and 30,000 office expense. Office expense not allowed, 80 is within 20% limit. So it will be allowed. If interest was 1/10, so we would have restricted it to 20%, that is 1 lakh. Then day-to-day expenses like we allow in PGBP, we will allow in IFOS also. If there is any asset, uska depreciation will always be allowed, and any expenditure which is incurred for earning IFOS. Same policy as PGBP. IFOS calculation is majorly similar as PGBP only, and we have already seen deduction against family pension 1/3 or 15,000, whichever is lower, and interest on compensation mein flat 50%. There are some disallowances also. Any expense under casual winnings disallowed, and any direct tax paid, or TDS not deducted 30%, 100%, excess payment to relatives, cash expense in excess of 10,000, or certain expenses only on payment basis. All the PGBP provisions are applicable in IFOS. PGBP, IFOS almost same. Regular to PGBP, irregular to IFOS. Okay. And now, the biggest part of IFOS, that is receipt of gift. Gift will always be taxable under IFOS other than employer. So there are some conditions, huge number of conditions. Let's see what do we have. Gift is taxable for all assessees. So let's not create a distinction between individual or others. Everyone. It can be in the form of money, or from 2009 kind gift also became taxable. Only from 2009. But only if it is one of the following assets: sculpture, artwork, drawing, archaeological collection, painting, jewelry, bullion, shares and securities, immovable property, or mitro, latest, taja garma garam, anybody giving you Bitcoin or Dogecoin. Dogecoin is very precious, hold it. If you have received a virtual digital asset, that is crypto or NFT or token as gift, so that will also be taxable, provided it is capital asset for the receiver. If any of these is not your capital asset, then it will not be taxable. It has to be capital asset. So all assessees, money or asset, but only selected asset. Car received as gift is not taxable. Pen received as gift is not taxable. Okay. But if the pen includes any precious or semi-precious metal or stone, diamond studded watch or gold plated watch, then it will become jewelry and fall in this. Normal pen or car or anything, not taxable as gift, and it has to be capital asset for the receiver. If it is a stock in trade or any other asset, then it will not be taxable. Further, following cases, gift will be fully exempt on the occasion of marriage. That one occasion where even income tax has sympathy with you. Any gift on the occasion of marriage will be fully exempt. Anything received under death, will or inheritance is going to be fully exempt. Anything received from local authority, charitable trust, medical institution is going to be fully exempt. However, if it is received by specified persons, author, founder, manager, trustee, then not exempt. So there is an amendment here also. Gift received from trust or institution is exempt. But if it is received by author, founder, manager, trustee, then it will not be exempt. If you get any purchase consideration on amalgamation or demerger, then it is going to be exempt. Anything received from relative, देखो marriage में anybody gives you, it will be exempt. But relative giving you without occasion also exempt. We have the definition of relative separately given. Relative means for HUF any member. For individual, it can be your spouse, your brother and sister, spouse ka brother and sister, your parents means mother's brother, sister and father's brother, sister. Lineal ascendant means father, grandfather, great grandfather. Lineal descendant means son and daughter, grandson, granddaughter. Father-in-law, mother-in-law, lineal ascendant. Father-in-law, grandfather-in-law, lineal ascendant of spouse. And descendant, sir, descendant, my descendant and spouse descendant, if they are stepchildren and spouses of these people, they all are your relative. If they are giving you a gift, irrespective of occasion, it is going to be exempt. And other than relative, if your friend is giving you gift on the occasion of marriage, of course, it will be exempt. Death, will, inheritance, it will be exempt. Further amendment, any expenses reimbursement relating to COVID illness to self or family. Now, this family is different from this relative. In this amendment that they have brought, COVID related amendment, they have said COVID illness of your family. This is revision cum amendments. COVID illness in family. So what is one amendment already? Virtual digital asset is covered in gift. Second amendment, author, founder, manager, trustee receiving from trust, they will not get exemption. Third amendment, COVID related illness in your family. This family is different from relative. For exempt gift, so many people are relative. Your father and mother ka brother, sister are also your relative. But your family is only spouse, children and parents and siblings if dependent. So spouse and children, whether dependent or independent. But parents and siblings only if dependent. Spouse, children, dependent parent, dependent siblings. Spouse, children, dependent parent, dependent siblings. For COVID illness exemption, only this much is family. But for gift exemption, all of them are family. So within the gift, there are two definitions of relative. This is bigger relative for all exempt gift, and this is your small family, self obviously, spouse and children always, and parents and siblings only if dependent. If any of them had COVID illness and you incurred expense, self or family, you incurred expense and someone gave you the money back. Reimbursement of COVID expense received, you receiving it free, but exempt to support those who had COVID in their family. If you are getting reimbursement, it is going to be exempt. Reimbursement of expenses of COVID related illness to self or family given from any person is going to be exempt. And supposingly anybody has died due to death, died due to death due to COVID. death due to COVID, and obviously this time you will not get the money. No family will receive money. So they are the ones who can receive money. Any death due to COVID and family has received money when? Within 12 months from death. If your employer is giving, who's employed? The person who has died. Then any amount will be exempt. And if you are getting it from any, government or anyone, then up to 10 lakh is exempt. Government giving you 15 lakh, 10 exempt, balance taxable. Employer giving you 20 lakhs, fully exempt. So if a person has died due to COVID, so family will get compensation. He cannot get compensation. He has died. Family includes spouse and children, any parents and siblings if dependent. If boss is giving compensation, fully exempt irrespective of amount. Any other source of compensation up to 10 lakh it is going to be exempt, provided the money is received within 12 months of death due to COVID related illness. And reimbursement of expense, always unlimited amount will be exempt, because you are going to get only to the extent of actual expenses. No, so unlimited amount is going to be exempt, and that can be received by self or family. Any other notified case also gift will be exempt. This is the bigger meaning of relative for all the exemptions, but only for this COVID part there is a smaller meaning of only for this. Those thinking कि सर आप हिंदी में लेक्चर क्यों नहीं लेते हो, हिंदी में कैसे लेक्चर लेगा, I cannot say कंप्यूटर लटक गया था, I have to say hang. So basically for COVID related matters, family ka definition is small, but the larger definition of relative, obviously you can see it is big. Finally, the chart of gift. First we will see if it is a monetary gift. We will see the taxable sources. So remove anything received from relative or on the occasion of marriage or COVID. Remove all of that. Take only the taxable sources and take the total. Total. You don't get 50,000 limit per transaction. It is total. So remove the exempt sources. Take the taxable sources and take the total. If the total is more than 50,000, it is fully taxable. If you receive gift of 50,001, this 1 rupee is of bad luck. Because of this 1 rupee, the entire 50,001 rupee will be taxable. So total exceeding 50,000, entirely it is going to be taxable. Alternatively, you can receive gift of asset also. If the asset is movable property and received without any consideration, so FMV is your full gift. And if it is inadequate consideration, so FMV minus the amount that you pay. FMV minus the amount that you pay. Both cases we get separate limit, same calculation, total from taxable sources. So remove the exempt sources, take the total. If it is more than 50,000, fully taxable. Remove the exempt sources, take the total more than 50,000, fully taxable. But the difference is that here and here, all the three places we get separate 50,000 limit. That is more important. That is what you need to understand. And as far as our immovable property is concerned, if you see the chart going down, if it is no consideration, then entire, not FMV, this time we will take the stamp duty value. If it is no consideration, then stamp duty value. And if it is more than 50,000 rupees per transaction, in movable property and cash gift, we take the total of the year. All the transactions, we get total limit of 50,000. But here we get limit per transaction. If it is more than 50,000, then in that case, it is going to be fully taxable. If the total is more than rupees 50,000, then it is going to be fully taxable per transaction. And if we talk about inadequate consideration, stamp duty value minus amount paid. Stamp duty value minus amount paid. That is going to be your gift component. That is going to be your gift component. That is going to be the gift component as stamp duty value minus the amount paid. That is going to be the gift component. Same limit of 50,000. But once again per transaction. So if I give you 1 crore gift free of cost, so 1 crore is gift. And if I charge you 1 lakh rupees, so 99 lakh is the gift. And every transaction you get 50,000 limit. Here also it will be fully taxable. But here, as you are aware, there is option of agreement date, stamp duty value instead of possession date. Option to take agreement date, stamp duty value instead of possession date only if some consideration was paid at the time of agreement in the allowable modes, and if the difference is up to 10% of actual, exactly what we did in capital gains. If the difference is up to 10% of actual, then the actual amount will be taken. There will be no gift. For example, actual is 2 lakh. Stamp duty value is 2 lakh 30,000. Difference is 30,000. This is more than 10%, but less than 50. No, we have 50 ka limit also. No, so not taxable. Actual is 6 lakh. This is 655. Difference is 55. More than 50, but within 10%. No, so not taxable. 10 you will check on actual. 5 lakh and 5 lakh 60. This is more than 50,000 and more than 10%. More than 50 and more than 10%. Accordingly, the entire 60,000 is going to be taxable. Last point under IFOS, one of the most controversial aspects, angel tax, startup tax, 4 conditions. There is a private company that has done issue of shares to resident. Private company doing issue of shares to resident. Private company doing issue of shares to resident. The issue price is more than face value. The issue price is also more than fair market value. Private company doing issue of shares to resident. Issue price is more than face value, so premium. Issue price is more than fair market value also. So there is going to be IFOS. Issue price minus FMV. The entire premium, nahi, only the excess over FMV into number of shares. For example, face value is 10. FMV is 40. So up to 30 rupees premium is allowed, but you have issued it for 50. So the difference between 50 and 40, that is 10 rupees per share into 1000, 10,000 will be taxable. Private company issuing shares to resident more than face value and more than fair market value, then in that case it is going to be taxable. Is that understood? With this we finish our heads of income, all of them, and now we have just the small chapters, clubbing, set off and deductions remaining as far as intermediate students are concerned. And obviously for final students also, what is left, you know that there are 3 extra chapters. I'll take about 5 minutes for revising them orally only we will be doing, because in class also we do from ICS study material only. So next chapter, clubbing of income, CA students, expectation versus reality. This is not that clubbing. When income earned by one person is taxed for another person, it is called clubbing. When you have to pay tax on income belonging to other person. What are the cases? Transfer of income without transfer of asset. So you are transferring debenture interest to someone, but you are keeping the debenture with yourself. So income will be taxed in your hands, because you are the owner of the asset. So income also belongs to you. Just transferring in someone else's account is not going to help. So what people are doing, transferring asset to escape this, but this is revocable. So whenever I want, I will take it back. If there is revocable transfer of asset, so only income is not transferred, asset is also transferred. So that is also going to be clubbed in the hands of the transferor. The only case where it will not be clubbed if it is irrevocable transfer of asset. Next, whenever you have substantial interest in any business, that is 20% or more ownership, and from that business remuneration is paid to your spouse and the spouse does not deserve, that is more important. If it is a deserving remuneration, you have to pay. The spouse does not deserve, then the excess of the deserved amount will be clubbed, that is taxed in the hands of Mr. X. If you own substantial interest, that is 20% or more along with your relatives, then you can control payments from that organization. You bring the money to your house in the name of your spouse. If she deserves, no problem. If not, then the excess is going to be clubbed back. If you transfer any asset to spouse without adequate consideration, transfer of asset to spouse without adequate consideration. If you take adequate consideration and offer capital gains to tax, then no problem. Without adequate consideration, then in that case the income arising will be again clubbed in your hands. Transfer of asset to spouse, even if it is irrevocable. Dekho, revocable mein to you transfer to anyone, clubbing will apply. But irrevocable mein people can give to their spouse, no, so it will stay in their own house. So clubbing will apply subject to the following conditions. Condition 1, there was inadequate consideration. Because adequate consideration and no clubbing. No agreement to live apart. They are living together, means the income is coming in the same house. If they live separate, then that is not for tax evasion, that is for peace of mind, and therefore clubbing provisions are not going to be applicable. Transfer can be husband to wife or wife to husband. The word used is spouse, not wife. This is obviously applicable only to individuals, because HUF cannot have wife if you have the brain to understand. The relation of husband and wife should be at both occasions, at the time of transfer of asset and at the time of receiving the income. So I'll give you an idea. When your wedding day comes and you are taking the circles around the holy fire, you tell your priest to stop in between and tell, sir, excuse me, time please. Transfer your asset to your spouse. Not yet your spouse. Yet to become your spouse. So at the time of transfer, there was no relation. Lifetime, there will be no clubbing. Because at the time of transfer, the relation did not exist. And of course, for the receiver, gift on the occasion of marriage will be exempt. Correct? And there is no risk of taking the asset and running away, because you are already on the wedding day. If during engagement period you do that, there is risk of taking the asset and going away. Join the full course lectures to get more tax planning knowledge. Okay, don't just send me WhatsApp messages. Sir, my family business ka transaction, tax planning, tax structuring. No. Join the full course lectures. You will get plenty of lessons on tax planning also. If the asset is sold, then capital gain also will be clubbed. So not just the revenue income, but the capital gain also. Even if the form of asset is changed, so asset is sold and another asset is acquired, so second asset ka income will also be club. Even on indirect transfer, X is giving asset to Mrs. Y and Y is giving asset to Mrs. X. So that is also going to attract clubbing. However, if there is accretion to asset, by virtue of an existing asset, another asset is created. Sir, how? For example, X is gifting cow to Mrs. X. So cow ka milk income will be clubbed here, but the cow has given birth to a calf. That income will not be clubbed here. Supposingly X is giving shares. So shares ka dividend will be clubbed, but there is bonus. So that is accretion. That income will not be clubbed. And if the amount is invested in business, then business will generate profit. On that profit, we will invoke proportionate clubbing, and that proportion will be checked on the first day of the year. So if the gift of money is given in the course of the year, that will not be taken for clubbing purposes. At the beginning of the year, whatever is the capital invested by the spouse, that proportion of profits will be clubbed in the hands of the gifting spouse, the spouse that has gifted the money. If you transfer your asset to son's wife without adequate consideration, then same condition and all points are same, except that there cannot be any agreement to live apart. You cannot divorce your daughter-in-law. Apart from that, all other points are going to be same. Transfer of asset to any other party, to a trust or AOP, and who will get benefit? Spouse or son's wife. See, if we directly transfer to them, clubbing applies. So idea, create a family trust, give assets to the trust, and trust will provide benefits to them. So we are not directly transferring. Clubbing is still going to be applicable. Clubbing is still going to be applicable. If there is any income of minor child ka income will be clubbed in the hands of the parent. But which parent? Parent with higher income. That parent which has got higher income before clubbing. So if father ka income is 5 lakh, mother ka 6 lakh, then we will club it here before clubbing whichever is higher. Obviously, if separated, then maintaining parent. If one is no more, then the surviving parent. If both are dead, so clubbing will not be with the guardian. Guardian will only do the compliances. Minor will pay tax. We will do computation of income of the minor. Compliances will be done by the guardian. Child ke definition mein we will include your own child, stepchild and adopted child. But we will exclude child born out of an illegal marriage. Following cases, minor will pay tax. No clubbing. If there is special skill, if there is manual labor, if the minor is a disabled minor, in these cases clubbing provisions are not going to be applicable. And whenever there is amount clubbed in the hands of the parent in whose hands we are including the income, we will apply we will give an exemption of the amount clubbed or 1,500 per annum per child. Amount clubbed or 1,000 per annum, 1,500 per annum per child, whichever is lower. This exemption will be given to the parent. If a member of HUF is transferring any self-acquired asset to HUF for inadequate consideration, actual sale you can do to anyone. But if there is any inadequate consideration, then the income again will be clubbed in the hands of the member who has transferred, and other points like clubbing will apply even if it is negative income. So loss will also be clubbed, not just profit. Obviously, that means even if it is reducing tax, clubbing is compulsory. Unlike transfer pricing, which applies only if it is increasing the income, and clubbing is not a separate head of income. If we are clubbing anything in the hands of the spouse or anyone, then the head of income will be one of the 5. So debenture interest, if not clubbed, then IFOS. If clubbed, then IFOS. Any income, if not clubbed, where will it go? In the same head it will go. In the case of clubbing also, it's not a separate head of income. That's our chapter called clubbing of income. Next chapter, set off and carry forward of losses. Whenever you have one profit and one loss, we will allow you to adjust in 3 steps. Step number 1, inter-source adjustment section 70. Both sources are within the same head of income. For example, one business, another business, one property, another property, and we adjust them internally. Supposingly you don't have any profit in the same head, then you go to other heads, that is inter-head income. That's step number 2. Only if inter-source is not possible, it has to be compulsory done in order. You cannot go to inter-head if you have inter-source, and if you don't have inter-head also, then you can carry forward for future adjustment. So first, pick up a loss, search for profit within the same head. If not available, then only other heads. And if not available, then only carry forward. Set off is not allowed, it is compulsory. Set off is not allowed, it is compulsory. Inter-source adjustment. First step, loss from one source with another source under the same head of income, one by one. Salary mein to there cannot be loss. House property mein loss, we can set off against any house property. PGBP ka loss, if it is speculation loss, only against speculation profit. Specified loss, only against specified profit. But there is no restriction on the profits. The restriction is only on the speculation specified loss. Other business losses can be adjusted against anything. The restriction is on speculation specified loss, not on profits. And capital gains में long term loss can be adjusted only against long term gain, but short term loss can be adjusted against both gains. So once again the restriction is on long term loss. There is no restriction on long term gain. What about IFOS? If you have casual loss, no set off, no carry forward, the casual losses will lapse. Absolutely no set off, carry forward. If you have owning and maintaining resources ka losses, they can be set off, but only against profits of OMRH, only against OMRH, not against anything else. And other IFOS ka losses you can adjust. Other IFOS ka losses you can adjust against any profit in IFOS, including OMRH, because restriction is again only on losses. But casual winning ke samne you will not be allowed. Casual winning ke samne you will not be allowed. And if in a particular case the income is not taxable, if an income is exempt, तो उसका losses will lapse. उसका you will not get any set off or carry forward. Interhead, if you don't find profit in the same head, you go to other heads in the same assessment year. तो salary में तो there is no loss, you don't have to take it. House property में can we take it to other heads? Yes, everywhere except casual winnings. You can take it against salary, PGBP, capital gain, anywhere except casual winning, but maximum 2 lakh. If your house property loss is more than 2 lakh, LOP में it is possible. SOP में it is not possible, but LOP में it is possible. More than 2 lakh, then you can carry forward it to future years, but other heads के सामने maximum 2 lakh rupees. Under PGBP, obviously speculation specified का cannot be interhead, because within the head also they are not allowed to go anywhere else. But what about the other losses, other business losses? You can take them everywhere except salary and casual winning. Salary के against not allowed, but house property के against allowed, capital gain के against allowed, IFOS also allowed except casual winnings. Loss under capital gain, there is absolutely no interhead. Capital loss only against capital gains. Capital loss only capital gains, in that also long term only against long term. Losses under IFOS can be taken to other heads, but obviously not casual losses, OMRH, because within the same head they are not allowed, and this can be set off against any income. Matlab IFOS losses can also be set off against salary, house property, PGBP, capital gain, everything. And once set off is not happening, then you will have to carry forward. If you are not able to set off, then you will have to carry forward one by one. House property losses will be carried forward for 8 future years. Only against house property you can file belated. To UAD and house property, belated return is allowed. Speculation losses carry forward of 4 years. Only against speculation, because current year may be only against speculation. Return has to be on time. Specified losses, unlimited carry forward, but only against specified profit. Only if return is filed on time. Other business losses, you can carry forward for 8 years against PGBP, including these profits, because your restriction is on losses, not on profits. Return has to be filed on time. Capital losses can be carried forward for 8 years, but only adjust again capital gain. In that also long term against long term, return has to be filed on time. OMRH losses can be carried forward for 4 years, only against OMRH gains, only if return is filed on time. Unabsorbed depreciation, unlimited carry forward. You can adjust it against anything except salary and casual winning. And even if you file belated ROI, 2 places belated ROI allowed, and 2 places unlimited time limit allowed, 2 places 4 years time limit allowed, remaining places 8 years time limit allowed. This is how we will do set off and carry forward in case of discontinuance of business other than speculation. Normal businesses, then the unadjusted losses of the year of discontinuance can be adjusted against receipts in future years, even after 8 years. Supposingly you shut down your business other than speculation, other than speculation, other than speculation. Supposingly you shut down your business, shut down your business, shut down your business, and after 8 years your losses lapse, but now you get some receipt like bad debts recovered, then year of discontinuance ka loss can be adjusted. Loss can be carried forward only by the assessee who suffered the loss, only by the assessee who suffered the loss, except in case of amalgamating company or resulting company reorganization business, it can be carried forward by the successor. Loss of a business acquired by inheritance, then you can carry forward the losses of the predecessor. And if business income of wife or minor child is clubbed, then obviously losses can be adjusted. In these cases, other person will be allowed. Amendment in set of chapter, whenever there is any income discovered in course of search, requisition or survey, except TDS. TDS survey is not for income discovery. Search, requisition or survey, search, requisition or survey, no set off of any loss or unabsorbed depreciation against that income. So any income that is getting taxed under search, requisition, survey, that will be ineligible for adjusting any loss, that will not be used for setting off any loss. No loss can be adjusted against these concealed incomes that have been discovered by us. Now that's our chapter, set off and carry forward of losses. Before I start my last chapter, deductions under chapter 6A, because that is the last chapter and our revision lectures are going to get over, I know that after the end, you are not going to watch or listen to what I am saying. You are most likely going to not pay attention and just exit because the revision is over. I need to tell you a few important things. First of all, I love you and you are very good. You are a good human being and you are a good student. You are giving CA exams. Either you have cleared foundation and giving inter, or you have cleared inter and you are giving final. You are awesome. Tell yourself you are awesome. And I repeat, I love you. Thank you for watching these lectures. Thank you so much for all the love, affection, all the cooperation. And if you have really liked these lectures, so you can show some love by sharing some comments. Like ठोक दीजिए महाकाल की सौगंध ठोक दीजिए, like ठोक दीजिए. Okay. Thank you for all the love that you have given me. Apart from that, just to share some good news. Over 13 years, I have taught students at CA intermediate and CA final levels. But now I want to go down a little into the bottom mentoring part, because by the time the students come to me for teaching or coaching, they are already CA intermediate students. But I always feel that students should be conceptually strong. Exam is only a small part of life. Concept should be strong. Just sir 40 aa jayega, aggregate ho jayega, just I'll manage. I don't want that manage pass, which is why in association with Shesh Educare in Mumbai at 2 branches, we have 2 branches, one at Charni Road Opera House in Mumbai and second at Dadar in Mumbai. Both are extremely close to the railway station, both Charni Road and Dadar. I will now be working as the executive director over there, handling guidance and mentoring from first year junior college. So in Mumbai, after 10th standard, 11th standard is not school, it is junior college. From 11th to CA final, I will be heading all the student guidance and mentoring. And any student from Mumbai who requires any kind of guidance, assistance, right from 11th standard in this geography, right now we are having only 2 centers. In the near future, you may see us at more places. And if you have your younger siblings, your junior friends, your building friends who require this training, they are in the 9th class or 10th class, they are in 11th, but they now have to go towards chartered accountancy. They are in 12th, but they have to move to foundation. Please make sure that they require any kind of help, assistance, guidance, mentoring. They require any kind of opinion, whether CA is good for them or not good for them, any kind of career guidance. Please feel free to approach me with this mail ID that was earlier also shared with you, ss.taxguru4u@gmail.com. Please ask them to contact me on mail. Please make sure that we together are responsible for shaping the future of our country, and for that the concepts have to be very strong right from your base year, that is 11th standard, which is why I have taken up this assignment of guidance and mentoring right from 11th standard. So you please make sure that you communicate this to your friends and juniors. So thank you for all the love that you have given me over the years, which this becomes a new step, step in my journey, my professional journey. Also, thank you for all the love, and I would like to once again remind you, I love you. If you also do, then show me some comments. You can actually simply say, sir, I love you, and that is that student teacher wala love. There is nothing bad in that. Okay, so if you have really enjoyed these lectures, so show me some love, and I wish you best of luck for your exams. You may not be listening to me once I finish it, so I am telling you everything right now. Only at the end I will just say it is over. Thank you, bye. So my all good wishes with you. Thank you so much for being with me, and all the best for all your future careers, career goals, all your future efforts, endeavor for the rest of your life. All the best too. Of course, those who are in inter have to again come back in final, but those who are at final, all the best for everything in life. And don't forget the mentoring part, which I just told you about. Let's come to our last chapter, chapter number 40, deductions from gross total income. GTI is the total of our heads of income and clubbing set off. But from this GTI, when we get deductions, we get NTTI. We pay tax on this NTTI. That means, can I say these deductions are for our tax benefit? Our government is giving us tax benefits. Of course, by now we know that only in the old regime, not in the new regime with certain exceptions, and those exceptions are being tested in MCQs. A deduction like 80M or 80JJAA, they are asking you to compute income as per old regime, income as per new regime, tax as per old, tax as per new, and you have to be alert about the adjustment that they have asked. Okay, so GTI minus the income taxable at special rates because you don't get deduction, and any income under 3580 because you've already taken massive deduction. You will not get any deduction from these incomes. From your other incomes, you will be getting deduction. Deduction cannot be claimed against these above mentioned incomes. Other than that, you can take deductions. Income related deduction, if you are taking, it will be allowed only if your return is filed on time. Deductions will be categorized into 4. Expense related deduction, where you have to spend money to get deduction, like your ATC, D and G. Then your income related deduction, which can be specific income or other income. Other income may you have ATTT, ATTB. Specific income where you have put efforts. So income related will be further categorized into 2. And other deductions, it is only called category, but this has only one deduction. We finish it. Your a pagal aurat, section 80U, any person suffering from disability. So this is only for individual. Quantum will be flat. For normal disability 75,000, severe disability 1,25,000. These are the various disabilities that are possible, physical or mental, but there has to be a certificate from approved doctor in force. So you will be eligible for 75 or 125 category. 4 other deductions over. We just have to learn this and the 2 categories out here. Under income related deduction, we have specific income where you put effort to earn it, and other income which just like love, it just happened, sir. So other income related. What are specific income where you put efforts? So first of all, these are those deductions for which you have to file your return on time, and they will be added in your adjusted total income computation, alternate minimum tax. For example, ATJJAA. If you have any profit from processing of biodegradable waste, you will get 100% deduction over a period of 5 years. So 5 years tak PGBP equal to deduction, PGBP deduction. 6th year say it will come in income but no deduction. Whenever we want to give tax benefit for limited period, we put it under deduction. And if we talk about other income deduction, it has only 2 sections, and this category will also get over. What 2 sections? ATTTA and ATTTB. Deduction against interest income. TTA is for all individual HUF. This is only for resident senior citizen. Resident 60 years. So non-resident individual will come here, non-senior citizen will come here, HUF will come here. Here it will be actual interest of 50,000 whichever is lower, actual interest of 10,000 whichever is lower. 50 and 10 are maximum limits. Okay. This will be only against saving account. This will be against saving FD and RD, and the account can be in a bank or a cooperative bank or a post office. Up to this limit you will get, but be careful, this is only saving and this is also for FD, RD interest. If we talk about expenses related deduction, the biggest of all, ATC, investment and contribution. An individual can contribute for self, spouse, children, HUF for any member. Actual contribution or 1,50,000 whichever is lower, irrespective of source of money, it will be allowed. In fact, cash payment will also be allowed, but you have to make payment up to 31st of March, and there is a long list of contribution. Life insurance premium up to 31st March 2012 ka policies, 20% of sum assured. After 12-13, 10% of sum assured, and after 1/4-13 only for disabled 15%. Other points may in full course lecture we have already marked which one to pay attention, which one not to pay attention. So you all already know, it's a long list which to pay attention to, which not, you all already know. Next is 80CCC, only for individual for investing in pension fund of insurance company. Pension fund of mutual fund company is already covered in 80C. So insurance company will come here, actual or 1,50,000 whichever is lower. And when you contribute to government ka pension scheme, first of all here you can also contribute, boss can also contribute. But let's finish the boss wala part first. This is only if you have a boss, not for the self-employed. Only first added to salary. It will be first added to salary because boss is giving you extra benefit. And this is allowed in the new regime. Why? Because we've added in salary, but it has directly gone in the NPS account. Allowed in the new regime. 80CCD2, 80JJAA, 80M, 80LA. There are some which are allowed even in the new regime. What will be the deduction? Actual contribution by the boss or 10% of salary, whichever is lower. Salary will be basic and DA in terms. Actual contribution or 10% of salary, whichever is lower. And for government employees, central government was existing. Amendment में state government will also be covered. So central government or state government का employee के लिए we will not take 10, we will take 14. So actual or 10 whichever is lower, actual or 14 whichever is lower, subject to these conditions. 80CCD2. Now when you yourself put, it can be from your salary or from your any other income. In 1B you get flat 50,000. So here there are multiple limits. You first keep 50 aside for 1B. If you've contributed 2 lakh, take 50 here and bring 150 for these limits. If you contributed 1,80,000, take 50 here, bring 130 here. First preference, give 50 here. Then come here. You are remaining with, you are left with the other, means 180 may say 50 gone to 130, 130 or 10% of salary, whichever is lower. 130 or 10% of salary, whichever is lower. But these people can be non-employees also. It can be business income may say contributed. So for that we will take 20% of GTI. Actual contribution or 10% of salary, whichever is lower, or actual contribution or 20% of GTI, whichever is lower, after keeping 50,000 separate for this. And if you commute your pension for opting out of the scheme, up to 60% of that lump sum received is going to be exempt. A very important section, deduction under 80C, individual limit is 150, 80CCC, individual limit is 150, 80CCD1, only this part, that total will be restricted to 150. So this does not fall in the 150 limit, this also does not fall in 150 limit. Here you have only 50,000 and here you have this 10 or 14%. 150 ka limit is applicable only on this particular point, and I already told you first preference will be given to 80CCD 1B as it does not suffer any other restriction. 80D, medical insurance, premium and other expenses. Individual will get and HUF will get. Individual, when the expenses incur for self, spouse, dependent children. In 80C it is any children, but here it is dependent children. And parents, in 80C parents ka contribution is not covered, but here it is covered. And HUF ka any member. Premium, cash not allowed, otherwise you can take here and HUF can also take the deduction. Contribution to central government or state government health scheme, you can take the deduction within the limit of this category. Here you cannot take, HUF also cannot take. If you have incurred expense for preventive health checkup, first of all here to cash will also be allowed, because checkup expenses can be in cash also, but HUF will not get it. Individual will get in both categories, but the total of these two cannot be more than 5,000. So wherever you are having more limit remaining, utilize that first and take the other at the other place. But if your patient is resident, senior citizen, no insurance. Resident, senior citizen, no insurance. There is no insurance. So we will take hospitalization expenses also, in fact, in all the three categories. Resident, senior citizen, no insurance. If you have insurance, you don't have the option of taking insurance or expense, whichever is better. No. If you don't have insurance, then only you can take hospital expenses. Take the total at all the three places, but restrict it to 25. So HUF ka total will be restricted to 25. Individual ka self, spouse, dependent children category maximum 25. Parents category separate 25. And if the contribution is for a resident 60 years, then the total will be restricted to 50. This 25, 25, 25 will enhance to 50, 50, 50. The limit will be increased if the patient for whom you have contributed, you nahi, assessee nahi, the patient. So you can be contributing for senior citizen parents. If they have touched 60 years, then the limit will be enhanced from 25,000 to 50,000. This deduction has to be only out of your taxable income. And if you make any lump sum or bulk premium payment, so you can divide that payment on straight line basis over the years, financial years which are covered. Here also institute played a game. Supposingly 1st April 2018 I make payment for 5 years. So that's for supposingly 1 lakh rupees paid. So that is 18, 19, 19, 20, 20, 21, 21, 22, 22, 23. So per year I can take 20,000, which is within 25 ka limit, I can take it. Straight line pe I have a portion. Okay. And what are the financial years of the policy period? 5 years we have taken it. But institute gives a question where you made the same payment on 1st October 18. That means, can I say the period will go to 30th September 23? It's still 5 years. You made 1 lakh. Now what will you think? Sir, 18, 19 to 20 to 23, I will take again 1 lakh divided by 5, 20,000 per year. No, no. Here there are only 5 financial years in the period. If you observe here, we start with 18, 19. Then we have 19, 20. We have 20, 21. We have 21, 22. We have 22, 23. And we also have 23, 24 because we are already in September. So now your 1 lakh will be divided by 6 and that is how you will do it. All the financial years which fall in this range, if it's 1st April, it's a coincidence. That way it is 5 years. So you will be thinking, sir, 5-year policy, so 1 lakh divided by 5. 5-year policy, 1 lakh. No, sir. All financial years which fall in this range. Here also institute is playing games. Some of the intermediate RTB questions if you are going to. So be careful with respect to this. Next, section 80 DD. If you are maintaining a disabled dependent, any expense incurred or insurance policy taken, that will be your expense. Assessee can be resident, individual or HUF. Individual will incur it for spouse, children, parents or siblings. HUF for any member provided that is disabled and dependent. Disabled and dependent. Quantum for normal disability same as 80U, severe disability same as 80U. Certificate will be required, and obviously if the disabled is claiming 80U, then you will not get this. Any one of you will get it. You can't take both. Okay, so if you take 80DD, disabled will not get 80U. If disabled is taking 80U, you will not get 80DD. You can take only one of them. If you have incurred treatment expense for specified disease like cancer, dementia, leprosy, AIDS, then we will allow you deduction because it will be massive hospital bill. Deduction will be allowed to resident individual and resident HUF. Individual can incur the expense for self, spouse, children, parents, siblings, HUF for any member, and these people have to be dependent on the individual or the HUF respectively. First step will not be deduction. First step will be to compute the qualifying amount. Qualifying amount will be actual expense or 40,000 whichever is lower. Actual expense or 40,000 whichever is lower. But if the patient is resident senior citizen, then actual expense or 1 lakh whichever is lower. Actual expense or 40,000 whichever is lower, or actual expense or 1 lakh whichever is lower will become qualifying amount, and from this qualifying amount any reimbursement received from insurance company or employer will be subtracted, and that will become your deduction. Next, 80 Gagga, scientific research, rural development, urban poverty eradication. If you are incurring these expenses, you get deduction in PGBP. But what about those who don't have PGBP? Then they can't take these deductions, so they can take this deduction. Those not having PGBP can come here. 80 GGB, GGC, expense by Indian companies and others. What? Contribution to political party or electoral trust. Contribution to political party or electoral trust. 100% deduction of your expenses will be allowed, but if the expense is incurred in cash, it is not going to be allowed. 100% of your expense, but not if it is incurred in cash. Next, 80E, interest on higher education loan. This is only for individual. Only interest is allowed, principal is not allowed. Loan can be taken for self, spouse or children. There is no limit. Actual interest paid will be fully allowed, but for a total of 8 years. So whenever you start repayment plus 7 years, tax benefit will be total of 8 years without any monetary threshold. You can take any deduction, but only of interest, not of the principal. And higher education means after 12th, any education recognized by central government, state government or local authority. Interest on home loan ke liye we have two sections, 80EE and 80EEA. What are the conditions? Both cases assessee has to be individual. Both cases it has to be your first house. So SOP. If it is LOP, the full deduction is given. No? SOP then maximum 2 lakh. And that 2 lakh you have to take first. If your interest is more than 2 lakh, balance will come here. So LOP mein to full amount we take there. You don't need this. SOP mein there you have to first take 2 lakh. Remaining you bring here. First preference will be to 24B. The main difference is this loan was taken during 16-17 for this section. And loan taken 19-20, 20-21, 21-22. 21-22 tak. They have unfortunately not extended. So loan was taken in this period. Interest can be paid even now. Quantum of deduction will be actual interest of 50,000 whichever is lower. After taking 2 lakh in SOP, the remaining or 50 whichever is lower. And here the remaining or 1 lakh 50 whichever is lower, with the conditions that the house ka value, stamp duty value should not be more than 50 lakh and here should not be more than 45 lakh, and here there is a limit on the loan value. House 35 maximum, house 50 maximum, loan 35 maximum. Here the limit is only on the value of the house. There is no limit on loan, but of course the loan value will be lesser than the house ka value only. Okay. Whenever you make repayment of home loan, principal ka deduction you get 80C mein. Interest ka first you have to take house property mein 2 lakh. Balance ka you can take year or year depending upon in which year your loan was taken. And any interest on the loan that you take for purchasing electric vehicle only for individual, maximum 1,50,000, and this loan can be taken during this period. Obviously whose interest ka any other chapter mein, like PGBP mein, you will not get deduction. Donation ka deduction will be available to all assessees, but only monetary kind donations not allowed. Cash more than 20,000 to more than 2,000 to fully disallowed. Cash maximum 2,000 allowed. You have to file the statement of donors and donation has to be given to approved person. Donation ka there are categories. First, unlimited where actual amount fully qualifies. Second, limited where actual donation will be restricted to 10% of adjusted total income. What is adjusted total income? GTI minus the special capital gains minus other deduction. This is adjusted total income. Iska 10% will be compared with actual donation. Whichever is lower will be qualifying amount, and here full amount actually donated will be qualifying amount. And in both categories, sometimes you get 100% of qualifying amount, sometimes 50. Both categories, this is qualifying amount, no? Deduction is iska full ke half. So limited category mein, in the half rate we have fallen. Any donation given to government or local authority for other than family planning, because for family planning it will come in 100%. Repair and renovation for notified temple, church, mosque, gurudwara. Any body formed to protect interest of minority community. Any body formed to provide affordable housing, and any approved charitable trust. They all come in limited 50%. Limited 100 में already government and local authority for family planning is covered, and donation given to Indian Olympic Association or any other notified sports body will be covered, but this deduction is only for Indian company. Unlimited category में भी we have 150. The donation given to Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi Foundation Memorial, we get 50%, and Prime Minister Drought Relief Fund also 50%. In 100%, you don't need to learn the list, but as a clarification, the other funds in the name of Prime Minister, like Prime Minister National Relief Fund, Earthquake Relief Fund, they all come in 100%. National Children's Fund comes in 100%, and contribution to Swachh Bharat Course, Clean Ganga, National Fund for Control of Drug Abuse, they all come in 100%, provided it is not for CSR. If it is for CSR, then the deduction is not going to be allowed. If you are paying rent, then as an individual, we will give you deduction of list of the following: 5,000 per month, 25% of your adjusted total income, same calculation, and rent paid minus 10% of adjusted total income. But conditions: you should not be getting HRA, you should not be claiming 1039, you should not be having house in some other city where you are claiming SOP benefit, and in the city in which you are living, your spouse or minor child should not be having, or your HUF or yourself should not be having any house, subject to these conditions, which is also very lower amount, so not very important. You can read through this. This takes us to the last category of deductions: income related deduction. 80 IAC, 100% deduction for startups. 100% deduction, 3 consecutive years out of first 10 years. 3 years out of first 10, and they have to be consecutive. You can't take 2, 4, 6. You can't take 9, 10, 11. 1, 2, 3, 2, 3, 4, 3, 4, 5, 4, 5, 6, like that. 3 out of first 10 and consecutive. And whichever year you are taking deduction, that year your turnover should be maximum 100 crore. Turnover should not be exceeding 100 crore, subject to certain conditions. You should be eligible startup doing eligible business. Innovation, development, improvement, new product, look at the conditions. Eligible startup means company or LLP incorporated during this period, 1 year extended year due to COVID, certificate from Inter-Ministerial Board of Certification. It should be a new business, not splitting up or reconstruction of existing business. Maximum second in local plant and machinery, 20% of total plant and machinery. Go check 35 AD, go check 10 AA, everywhere we have these conditions. CA report will be compulsory. Inter-business transfer at FMB, otherwise AO will recompute, and deduction will be assuming this is the only business. In other words, the eligible profit will be after adjusting the brought forward losses of this business. Only that much deduction is going to be allowed. 80 IBA, for housing project, developers will get deduction, including rental housing project. 100% of profit from this project which is fulfilling the condition. 100% of profits from this project which is fulfilling the conditions. What are the conditions? The project should be approved between this period, 1st June 16 and 31st March 22. Extension not given. The project should be completed within 5 years of approval. Only one project on that land parcel. You cannot have a small housing project and then a bigger luxury project on the same land. Separate books of accounts for this project to prove that it is fulfilling the condition. In this project, if you sell one house to any individual, then you cannot sell any other house to that individual, uska spouse ya minor child. The stamp duty value of the house should not be more than 45 lakh. If you are only a contractor, you are not eligible. The developer is eligible. If the house is in metro cities, Mumbai, Chennai, Delhi, Kolkata, Bangalore, Mumbai metropolitan region or national capital region, then there are some rules, and for other places some other rules. In the big cities, the plot size should be minimum 1000 square meter. It can be bigger. This is minimum. But small cities, it has to be even bigger, minimum 2000. Here in the big cities, you can leave maximum 10% vacant. So construct minimum 90% on the land. Don't leave vacant more than 10%. But in small cities, you can leave 20% vacant. You should construct at least 80%. And the individual house ka area, here cannot be more than 60 square meter. This is maximum. So it can be less, not more. And here it can be a little more, but up to 90, not more than 90. And in the total project, commercial shops and offices should not be more than 3% of the total area. Next, 80 JJAA, one specialty, it is allowed in new regime and tested in a huge number of MCQs. They give you income as per new regime, calculate tax as per old, and vice versa. This will be allowed in both. There will be no difference in income because of this. If this is allowed in old, it is always be allowed in, it is also going to be allowed in new. But be careful which employees are eligible, not eligible, because if you don't count that quantum correctly, you will definitely go wrong. So be very careful in identifying what is allowed, what is not allowed. This is for assessees that are covered under 44AB. 30% of additional employee cost for 3 continuous years. So last year you appoint to last year, current year, next year. Computation of additional employees. If it is existing business, new recruitments. And if it is new business, to all employees. But it has to be paid in the 3 allowable modes. Anything paid to following employees not allowed. Not allowed for deduction purposes. Employee earning more than 25,000. employee not participating in RPF, government is paying RPF, and employee working for less than 240. This is tested. This point and this point are tested in huge number of questions. Employee less than 240 days, not to be included. But if the employee is in these industries, then 150 days also allowed. So normally employee working for less than 240 days, then disqualified. But for these industries less than 150 days, then disqualified. And if you employ for less than these days in the current year, but they continue in the next year for more than that, then they will be treated as appointed in the next year. This is to give benefit to those who appoint employees towards the later part of the year. So this year you don't fulfill number of days, but next year you fulfill, to count them as the employees employed in the next year as the first year out of the 3 years eligible. CA ka report will be compulsory. ATM, if you receive, and this is also allowed in new regime, if you receive any dividend from domestic company or foreign company or business trust, so you will be offering that income under IFOS. But if you use that money to declare dividend, so as a domestic company, you can take the deduction of the amount received or distributed up to 1 month before the return filing due date. Amount received or distributed up to 1 month before the return filing due date, whichever is lower, can be taken as a deduction. Next, any income of a producer company, not current job, but producer company as per company law, then 100% deduction of profits of this period, provided your turnover meets the criteria. And finally, in case of royalty income, 80 QQB and 80 RRB. This is for author, this is for scientist. First, compute the qualifying amount, which will be list of actual royalty, which is already gone in your IFOS. If it is on percentage basis, then 15% of sales value. And if it is outside India, then forex brought within the time limit or extended by RBI. This, whichever is lowest, will become your qualifying amount, and qualifying amount minus any expenses that you have incurred will become your deduction, but the deduction will not exceed 3 lakh rupees, maximum 3 lakh rupees per annum. So that was our chapter deductions under chapter 6A. First, I will tell you about the general notes, then the 3 extra chapters for CA final. Students, wherever we have referred to T scheme, transparency, efficiency, accountability, uska meaning I have given in chapter 17, IT authorities for facilitating faceless. Notice issued means handed over by department to post, but service means reaching the assessee. Agriculture income is exempt, only earned in India, outside India taxable, but only for resident under IFOS. Any income is special rate, no chapter 6A, but 80 LA is allowed, and royalty FTS under 115A you can take. Always decide long term, short term, even if no indexation, because rate of tax and set of rules will be different. If your answer is yes, there will be TDS, then you have to check whether all the conditions of that TDS section are fulfilled. But if your answer is no TDS, even if one condition is not fulfilled, it can be no TDS. In chapter 6A, you have to be careful about these things while calculating your deduction. And now if I talk about the 3 extra chapters for CA final, student, there is a chapter called base erosion and profit shifting. There are 15 ways in which you shift your profits to low tax zone or low tax jurisdiction. That was identified by OECD. They have given the problem, the solution, and Indian taxation change. And Indian taxation change we have already studied in some chapter or the other. Then we have tax treaties, application and interpretation, multiple ways of interpreting, including Vienna Convention, which you have to take very, very seriously. The rules of interpretation as per Vienna Convention in tax treaties. Make sure in all the 3 chapters you learn the questions behind the textbook. And Model Tax Convention is a pro forma given by OECD and UN, subject to certain differences. Income by income, you have to decide according to this model or that model, which income is taxable or which income is not taxable in the home country or in the host country. These are only 3 extra chapters of CA final, students, that we do from ICAI study material. So all the instructions were given before the deductions chapter itself. Thank you so much for watching. All the best. Lots of love. Bye bye. Enjoy your success and share your success. Also, we will also be very happy. Thank you much. Thank you much. Thank you very much. Bye bye. Bye bye.